Hey everyone, in this video we'll guide you on how to combine all the smart money concepts like pieces of a puzzle to execute high-quality trades. We'll break down each concept step by step and demonstrate how to apply them properly on the chart. The concepts we'll go through today include market structure, imbalance, liquidity, supply and demand, and also trade entry along with management. So, in short, today's video works as a complete smart money trading guide on its own. If that's something you're interested in, don't forget to hit the like button to show your support and subscribe to our channel if you're new here. We'll see you right after the intro and disclaimer. The smart money trading plan is built around two main time frames. First, we have the primary time frame where most of the overall analysis will be done. This includes reading the market structure to determine the direction, marking out key levels, imbalances, liquidity, and most importantly, identifying supply and demand zones that may provide high-quality trade setups. In the second stage, we'll move down to a lower time frame to look for confirmation and execute the entry. Keep in mind, this trading plan isn't restricted to a particular chart or time frame. Price action can be applied to any trading instrument. Still, we recommend running proper backtesting before committing real money. You can also choose any combination of time frames that suits your trading style. To simplify things, we've broken this plan into 5 straightforward steps. So, let's begin with the first one, analyzing the market structure. In this overall analysis, we apply the market structure concepts of smart money trading onto the chart. Identify the market direction and outline the trading range. When the market creates a 1, 2, 3 move and breaks above the previous high, a trend is established. If it breaks above the recent high once more, that confirms a trend continuation. This sequence of higher highs and higher lows indicates that the bulls are in control and the price is more likely to move upward again. As long as the price remains above the swing low, we stay bullish on this pair. Therefore, the trading range we focus on extends from this high down to this low. If price retraces deep enough for traders to enter long positions, it will likely climb again and create another impulsive bullish leg. Now, this was just a basic example of how to apply market structure principles. However, the challenge is that the market rarely looks this simple. Most of the time, it appears more like this. But don't be misled. Let's apply the same market structure framework. Here we have the most recent break of market structure, so we'll mark the swing high, swing low, and define the trading range. Every formation inside this range is treated as an internal structure, while the overall direction remains bullish. That completes the first step, analyzing the market structure to determine the direction and trading range. Now, let's move forward to the next step, which is identifying fair value gaps. So, what exactly are fair value gaps? A fair value gap, or FVG, is a price gap that occurs due to a sudden imbalance between the power of buyers and sellers. It is defined by a 3-candle formation where a gap exists between the wicks of 3 consecutive candlesticks, like this. Now, what does a fair value gap really represent in price action terms? As the name suggests, it indicates a gap between the fair value of price. Strong buying pressure has driven this aggressive movement, often linked to institutional activity, and as a result, price becomes inefficient. For a smart money trader, marking fair value gaps is the very first step when analyzing a chart. But why exactly should we mark fair value gaps on a chart? Fair value gaps are blank areas where the market moved sharply without much trading in between. The market frequently revisits these areas to fill them as price seeks equilibrium. Traders monitor these levels closely since price often reacts once it comes back to them. Moreover, a supply or demand zone that produces a fair value gap is generally stronger than a zone that lacks imbalance. If the price revisits such a zone, the probability of it acting as a strong reversal point increases significantly. Now, back to the previous chart, let's highlight the fair value gaps. Here, we can see 2 FVGs close to the current price. But what do they signify, and why is it important to mark them on the chart? The bullish FVG indicates that this move carried strong bullish momentum. The demand zone that formed this gap creates a high probability trading setup to go long, as the gap reveals that buyers were aggressive in this region. When price returns, those buyers may defend their positions, lifting the market back up and giving us a favorable entry with lower risk. The bearish FVG, on the other hand, tells the opposite story. It signals that this small internal move carried strong bearish momentum, which could even drive price below the demand zone and potentially trigger a reversal. However, if the retracement completes and price climbs back up toward the level that created this FVG, it strongly suggests that the market may continue pushing higher. Now, let's move on to the next concept. Identifying liquidity. Liquidity levels are zones on the chart where a large cluster of orders, such as stop losses or pending trades, are likely positioned. These levels act like magnets for price, often attracting it toward them before a significant move takes place. Let's picture this as our recent price action. We understand that if price pulls back into the demand zone, many price action traders will look to go long and set their stop loss orders just beneath it, expecting to catch a bullish rally. If price then continues higher and approaches the swing high, traders may treat it as their target, secure profits, or even enter short trades at the resistance level. This means liquidity builds both below swing lows and above swing highs, which we describe as sell-side liquidity and buy-side liquidity, respectively. Now, let's discuss the main liquidity types you need to mark on the chart. The first type is swing highs and swing lows. We've mentioned these terms several times, but what do they actually mean? Swings are turning points in price where three candles form a specific structure. A swing high occurs when the middle candle makes a higher high compared to the candles on both sides. A swing low occurs when the middle candle makes a lower low compared to the candles on both sides. This pattern is only confirmed once the third candle has closed. In this example, these are the clearly visible swing highs and swing lows. Keep in mind, you can also apply a 5-candle swing pattern, which often makes the swings more reliable and provides stronger confirmation signals. Now, let's move on to the second type of liquidity: equal highs and equal lows. As the name suggests, equal lows are formed when the low points of price action rest around the same level. Similarly, equal highs appear when the high points are aligned at roughly the same level. So, what does this mean in terms of price action? Double or even triple bottoms formed on the chart create strong areas to watch for trading setups. Many retail traders anticipate a bounce to the upside once price revisits this zone. As a result, they enter long trades here and place their stop losses just below. But, as we've explained earlier, smart money targets these stop losses. That's why it's crucial to wait until the liquidity has been collected before entering the trade. If a demand zone lies beneath the equal lows, there's a strong probability price will break through, sweep the liquidity, and then move higher. This forms one of the core trading patterns in smart money concepts, allowing price to trigger retail stop losses first, then entering the market from the demand area. Next, let's discuss another important liquidity zone: turning points. Turning points are chart areas where price changes direction after a long-term trend. These levels are often viewed by the market as overbought or oversold, which increases the likelihood of a reaction when price revisits them. They carry significant liquidity since they attract attention from both retail and institutional traders. Daily highs and lows are also critical liquidity levels. The daily high represents the highest price reached during the trading day, while the daily low is the lowest. These levels tend to attract heavy trader activity, with many placing their stop losses or pending orders around them, making them rich in liquidity. Now that we've covered the main liquidity zones to mark on the chart, let's move on to the next concept: marking supply and demand zones. Supply and demand zones are chart areas where traders entered the market with enough volume to drive price sharply away from that level. Typically, we mark the origin of this strong move as the supply or demand zone and expect price to reject it when revisited, due to repeated market behavior. However, there are several important factors to consider when identifying valid supply and demand zones for trading. These include inefficiency, break of structure, and push distance. Each one provides a key clue in determining the strength and reliability of the zone. Inefficiency occurs when price exits an area quickly, creating an imbalance between buy and sell orders. This imbalance is often visible as a fair value gap between consecutive candles. Such gaps highlight a lack of supply or demand at that level, making it a possible turning point. A break of structure takes place when price moves beyond a major support or resistance level, signaling a shift in sentiment and confirming the potential strength of the supply or demand zone. Every time price breaks a structure level, the chances of trend continuation increase. The push distance measures how far price travels away from the zone before pulling back. A larger push distance usually reflects a stronger rejection, which in turn strengthens the zone. By evaluating all these factors together, you can more effectively spot high probability supply and demand zones for your trades. For instance, if we plot zigzag lines on the euro-dollar 1-hour chart, we can clearly observe the highs and lows being marked. The most recent impulsive move fulfills all the conditions for a high-quality demand zone. It has formed a fair value gap, broken through the prior market structure, and driven price upward by a significant distance compared to earlier moves. When price retraces back into this zone, the probability is higher that it will reject the level and continue advancing upward. Now, in this part of the video, let's look at a couple of real chart examples to demonstrate how to combine all these smart money concepts like puzzle pieces to enter a high-quality trade. Here on the euro-dollar 1-hour chart, we can see a bearish market structure formation. Therefore, we are only focused on selling opportunities. The first step is to outline the trading range. This is the most recent breakout, so we mark the range from the swing low to the swing high. This tells us to expect the correction within this range before the next downward impulse. If price breaks above this protected high, the entire bearish outlook becomes invalid. Now, where could our supply zone be for short entries? To determine this, we first mark imbalance and liquidity. There is no clear structure to use as a liquidity level, but here we spot a fair value gap zone. Essentially, the candle that formed this gap can be treated as a supply zone to look for selling setups. We can also mark the last bullish momentum candle before the bearish impulsive leg as another possible supply zone. It doesn't really matter which one we choose, since later we'll refine the entry by zooming into a lower time frame. Now, let's push price forward to see the outcome. The market has created equal highs, which we mark as a key liquidity area, as these levels may attract stop losses from sellers and buy stops from breakout traders. If price breaks above these equal highs and then retraces deeply into our trading zone, it could give us a strong trade setup. Our plan is to wait for price to tap into the trading zone, then drop to lower time frames to confirm entry. Here, price has retraced all the way into our zone. But notice another important formation. This bullish move has produced a bullish fair value gap, showing strong buying momentum. This momentum might be powerful enough to push price beyond the supply zone. So now we see a battle between supply and demand. If demand proves strong enough to break above the high, we can no longer remain bearish on this pair. If supply dominates and breaks below the demand zone that created the gap, it gives us a solid shorting opportunity. Now, let's see the result. Supply has overpowered demand and taken control. To execute the trade, let's now zoom into the 15-minute chart for more detail. On the 15-minute chart, all we need to do is locate a supply zone to go short. The candle that created the fair value gap forms an ideal supply area for entering a sell trade. Now, let's play price forward. Here we have our first successful trade. But let's keep going and place more trades. Once again, we notice a fair value gap area. So, we'll mark the supply zone and set a sell limit. For this setup, we'll trail our profits. This means that every time price breaks lower, we move the stop loss to the most recent protected high. That way, even if price reverses, we lock in profit while allowing the trade to run. Here's the first breakout, so we shift the stop loss to this protected high. Another breakout occurs, so we move the stop loss again. This process repeats until price eventually reverses and triggers our stop. For this trade, we managed to capture nearly a 1-to-4 risk-to-reward ratio. This quick example shows how combining multiple smart money concepts can lead to highly effective trades. So, that's it for today's video. Thanks for watching. I hope you found the video informative and helpful. Don't forget to hit the like button, subscribe to the channel, and turn on notifications so you never miss our latest uploads. We really value your feedback and suggestions, so be sure to leave a comment below and let us know what topics you'd like us to cover in future videos. Thank you for your continued support. We'll see you in the next episode.